Good afternoon. My name is Tim Gregory. I'm from Vermeer Investment Management, and I'm here to talk this afternoon a little bit about the big hunt for yield that's been going on in markets in recent weeks since the big volte-face from the Fed. I'm sure you'll all be aware that there's been a very big move in the US 10-year Treasury yield, down from well over 3 in October last year to around 2.5% now. And what that's triggered is quite a sensational move towards investing for equities with a bias towards yields again. So stocks like utilities, telecommunications, and those areas of the market that have got high yields have started to do very well again, particularly as people have become concerned that the next move globally in terms of growth could be towards a recession. At the moment, we don't share that view. We think obviously growth is slowing, but we see little sign that the US, for example, will be in recession this year, although it's clear that economies like Germany have slowed considerably, and the industrial side of that economy is really struggling. But in China, there are signs of stabilisation with better economic data, and indeed the IMF actually modestly upgraded their guidance for the Chinese economy for this year, despite actually reducing their outlook for the world as a whole. But that reduction in outlook continues to highlight why interest rates have peaked and why 10-year US Treasury yields have come down in the way that they have over the last 7 or 8 months. And they've triggered this very big movement towards equities that have got dividend yields. One of the things that we like to look at is those companies that, rather than just having high optical levels of yield that may not grow, is those companies who may be able to grow their dividends over time and may start with a lower yield base. One stock that's done particularly well in the light of that has been Cisco Systems, for example, which sells on a relatively low valuation compared to many technology companies, but has performed particularly well because at the beginning of this year, the shares yielded over 3%, and they continue to grow that dividend, invest heavily in their company, and buy back the shares. And that's a very powerful combination for investors who are looking for yield and also looking for growth in a market where the economy is slowing. So we think that's a very good focus of attention for portfolio investors in general, looking for companies that have got yields of around 2 to 3% that will grow, could also be buying back shares, but are also growing their top lines as well. One sector that I've mentioned in the past that's a little bit different to that is the integrated oil sector, where many of the companies have significantly reduced their cash flow break-evens, have reduced capex substantially, and plan to continue to do that as we remain in a relatively low, compared to many years ago, oil price environment. So the planned investment for those companies is based on a sustainably low level of capital expenditure, strong cash flows that will enable them to continue to fund high levels of dividend and potentially some dividend growth and maybe share buybacks as well. This is potentially a very attractive combination, and although the investing market still moves in the oil price day to day, and of course that's been going up more recently, but there are patches when the oil price has clearly been under pressure, and investors lose sight at that time quite often in the fact that companies have lowered their break-evens, substantially generating a lot of cash even at a lower oil price, and are able to grow their dividends and grow their cash flow in the long term, particularly those integrated companies who have downstream refining assets that in many cases cover a substantial amount of the cash flows required for the dividend. And this is a very attractive cocktail for the long term. So these are some of the areas that we think are attractive to investors in this continued hunt for yield in what is quite a difficult market at the time. But good quality companies with decent dividend yields that are growing over time should be rewarding to investors, even if the market runs into a difficult patch in the short term, having had such a good run. That's a good long-term strategy as far as we're concerned. Thank you very much for your time.